high-low. All right. And at the end, if you see that total depreciation, accumulated depreciation is not greater than cost value. The difference between unit of production method and straight line method is that in straight line method, the depreciation yearly expense is evenly distributed, while in unit of production, it is unevenly distributed according to the usage, according to the number of miles it has driven. All right. So if we want to record the entry going to be simple depreciation expense to accumulated depreciation. Entry is the same, depreciation expense to accumulated depreciation. Only amount is going to change with respect to methods. If straight line method, answer is going to be different. If the unit of production method, entry is the same, amount is going to be different. All right. But remember, we charge the expense to accumulated depreciation, which is the contra account of asset. When asset increase, debit. When contra account increase, credit. All right. Like we make the account receivable allowance for account receivable over there, right? The same, we are establishing the depreciation account here. So measure and record the depreciation on plant assets. The last one is double declining method. So double declining method, as its name, double declining method is double of straight line. What is the straight line ratio? 1 over year. This is 2 over year. Simple. So you convert the ratio. So it writes off larger amount of asset costs near to start. All right. So let's just talk about this and then we discuss that. So remember, the straight line method is how we find out the percentage of straight line method. Simple, 1 over 5, where the double declining method is 2 times of the straight line ratio. So in this case, we find out depreciation rate, not the depreciation value. In straight line, we find out depreciation value per month. But here, we find out depreciation rate per month. Sorry, per year. All right. So how we find out the depreciation rate? 2 times multiply by 1 over useful life. So if you pay close attention here in our straight line method, we talked about that. This rate is coming from 1 over life, straight line rate. All right. So we calculated this rate to make you understand the double declining method. Multiply by 2. So that would be 0.4. All right. 0.2 multiply by it's 0.4, right? Let's just see that. So double declining method would be 40%. All right. So did you notice something? If this is percentage, then our first year, okay, we'll see in our coming slide. So remember, here we don't use depreciable amount. We use purchased amount, right? So we use purchased amount. So what is the first year depreciation? Purchased amount or cost of the account multiply by cost of the asset multiply by 40%. Answer is 16,400. Right? So 41,000 minus 16,400. Answer is 24,600. And what is the second year depreciation? Second year depreciation is on second year book value. Book value is 24,600. So you multiply 0.4 with 24,600. Answer is, let me just write it down here as well. So first year depreciation is equal to 40% multiply by 41,000. Answer is 16,400. Second year 40% multiply by 41,000 minus the depreciation. Answer is 24,600. Answer gonna be 9,840. So you less 9,840, 4,600. Answer is gonna be 14,760. The third year gonna be 40,000 multiplied by 14,760. Answer gonna be 5,904. Did you notice something? First year depreciation is the highest, and then low, 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 low. And the trick is the last year depreciation must be a plug figure, because depreciation, the book value can never be lower than salvage value. So you notice something, our fourth year book value is 5,314. What is the fifth year depreciation? 40% of 5,314. What is the answer here? Let's calculate that. So 0.4 multiplied by 5,314, it is 2,025. So if you less it 2125 from 5,314, so your book value going to be here 3189. So after 5 years, your book value must be equal to 1,000, not 3189. So you just write it down 1,000. 1,000. So your last year depreciation is the number between book value minus salvage. So book value is 5,314 minus salvage value. Answer is 4,314. So this 4,314 is not the 20% of 5,314. 40%, sorry, 40% of 40% of 5,314. It is just a plug and play figure. Right, guys, you understand? So you calculated the double declining rate 40%. So our first year value is book value multiplied by 40%. Answer is 16,400. So you ignore the residual value in computing depreciation last year. So you just multiply by 40% to book value, not the depreciable value 40,000. Remember this one. The difference between straight line, unit of production, and DDM, double declining method, is that the double declining method use book value for depreciation, while the unit of production method, UOP method, or SL straight line method, they use this depreciable value, which is book value, cost price minus solid value, which is 40,000. But the double declining balance method is using book value, 41,000. All right. So what is the last? The last or final depreciation is the book value less the residual value. Guys, you understand? Oliver, Subhan, Priscilla, Benicia, Naku, PD,
Yes.
Nivia, Tara, Mina, Noon, Mirko, Momo. Understand?
Yes, sir.
Okay, good. So, like I told you, the final depreciation is a plug amount needed to reduce the value to the residual value. Now, it's time to think about that. So I'm going to be, I think this would be necessary. Let me set up the breakout room. Please take a picture and find out the depreciation and accumulated depreciation and the book value here. So let me set up the breakout rooms. Please take a picture. I'm making 3 breakout room, okay? Please accept. So those who are watching online, so I would be resuming our recording after the breakout room activity. All right. Okay, class, welcome back after the breakout room activity. So our first year depreciation going to be cost multiplied by the rate. That would be here, right? So our end, because the depreciation can never be below, the accumulated depreciation or the book value can never be below, the accumulated depreciation can never above the scrap value, and the last year's depreciation, it would be 0 if the value exceeds the scrap value or residual value. All right, well done. So if we compare the method here, so remember for straight line, so which method is used for, which method best serve the purpose? So straight line serve purpose for those plant assets which generate evenly revenues. So if you know that, okay, revenue going to be generated evenly. And unit of production method going to be used for the assets who are going to wear out the more we use. For example, machinery, production plant, cars, vehicles, the more you drive, it may need, more, more wear out, just like that. And double declining methods are used for those assets who generate large revenue during first year, less revenue during second, third, it's like that. So it's better to use double declining method. All right. So if you compare the methods here, you straight line generate even depreciation expense over the year. The unit of production generate uneven, and if you see the double declining method, it generate highest. You see, almost double depreciation during first year. So which method is used for which type of purposes? So remember, normally the double declining method is used for technologically oriented machineries. For example, producing mobile phones, their technology is going to be very obsolete after 2 or 3 years. So it's better to use double declining method. All right.